So welcome back, everybody. My name is Gav Blacksberg. I run the Wolf account. You can see my personal profile up here if you want to check that out. Today, we're going to be diving back into fundamental analysis. We did one of these spaces 2 weeks ago. In that space, we focused pretty high level fundamental analysis. We talked about researching the governance of the company, so people like their CEO, presidents, things like that. We also went a little bit into free cash flow. Today, I would love to focus on a couple different areas. One, I think we're really going to focus on earnings. So, when a company releases earnings, what are the type of things that you want to look for? How should they be affecting your decision? How do you want to base that? Maybe off of what analysts are saying, because that's one of the things where it's like fundamental analysis is a continuous thing. Once you even own the company, you still want to keep going with. And then number two, I'd love to focus in on the statements. So talking about the income statement, balance sheet, cash flows, those are the three main ones for accounting purposes and the ones that people often dig into. So I'd love to get into those two topics overall. So let's dive right into things. Brad, you want to kick us off?
Sure thing. And you actually cut out for a second. So what am I talking
Oh,
about
sorry.
first specifically? No, I think it was my on my end.
Yeah, just to start off with, so I wanted to start off with the earning side of things, because you had mentioned with your company with earnings. So let's say,
Sure.
we're coming into like, maybe let's talk about it from two perspectives. You haven't started a position in a company yet, and you're looking at, here earnings come out, and you're like considering taking a position. What will, be the decisive factors? What are you looking for in earnings? And then you can also talk about like a company that you already own, because it's, buy and continuously verify is really the model. So you can talk to those perspectives.
Sure. So for me, the main pipeline of companies or where I find most of my ideas is as IPOs are coming out or as I guess occasionally as SPACs are merging. Unfortunately for me in Butterfly, it's the case today. But um, so kind of what when I read an earnings press release and when I read a 10Q, I mean, what I'm really looking for is how on a very high level how the tone changed from the quarter before to this quarter, how their expectations and projections looking forward 3 months came to fruition. How much they promised or under delivered, kind of along those lines, and really the evidence from that. The biggest piece of evidence is the top line or revenue. I'm sorry for revenue and revenue guidance. So in Butterfly specific case today, they first 2 quarters of the year, no problems, no issues, no supply chain issues. COVID-19 is behind us. We're good to go. $76 million 2021 revenue guide. And then today, with the rug pull, brought that down to a $61 million midpoint and cited some issues that other companies that I have in my portfolio, GoodRx, Progeny, cited identical issues and were able to kind of overcome that. So from a demand perspective, pretty cut and dry what I'm looking for. I'm looking for a number and I'm looking for reaffirmed or raised guidance to see if this company or any company can kind of deliver on that coveted pattern of under promise and over deliver and continue to deliver earnings beats. But kind of moving down, I guess maybe looking at the income statement and the cash flow statement. So when anyone you see on Twitter is talking about margins or gross profit margin, operating margin, cash flow margin, whatever it's called, what they're doing is looking at items from the cash flow statement or from the income statement, and they're dividing it by total revenue. So that's I mean margin division, pretty intuitive there. But in terms of what I'm looking for, I'm not when I invest in companies that are as young and as unproven as I'm generally looking at. I'm not looking at positive EBITDA margins. I'm not looking for free cash flow today. I'm not looking for net income today. I'm also not looking at sales multiples like a lot of other people do. For very young companies, I'm looking for gross profit margin to be pretty solid. And what gross profit margin means is it's revenue and then subtract out all the input costs that directly go into deriving that revenue. So when a company is early on and not optimizing for EBITDA, not optimizing for cash flow, that gross profit margin gives you a really good sense of how their unit economics look and how when they do start to try and optimize for EBITDA and cash flow, when growth starts to slow down, they start to mature, how that can start to translate into cash flow compounding and net income compounding in a much more efficient way than when you have a gross profit margin starting at 5 or 10% for some of these companies going public. So for Butterfly, I just want to kind of decipher between a good dip and a bad dip, and Butterfly offers a great example or great juxtaposition to some other companies that I've had. So Butterfly, 20% revenue guide down, went over it. The stock has now gone from 29 to $7, and if it goes to $5 or $4 or $3 or $2 or $1, that will not tempt me at all to start adding, because I talk about this a lot. I'm really looking for healthy companies first and foremost, and if the company's not healthy, I don't really care how broken the stock is, because in my mind, it's somewhat deserved. So looking across the board and kind of comparing it to another company that I had with CuriosityStream, let's talk about them. It's a young streaming subscription company, reaffirmed 2021 guidance, margins outperformed, lowest churn, lowest direct to consumer churn in their company's history, and it sold way off. So there, I'm looking at a 10 or 15% dip, not with excitement, and really with aggression, wanting to kind of embrace this greedy when others are fearful that Warren Buffett talks about all the time and that I cite all the time, because the company is healthy and because we have that healthy company. A broken stock to me is an opportunity, not something just to say, yeah, it's a broken stock. And just one more thing on philosophy before I talk for 20 minutes, and then I'll pass it off to some other people. And if you want to come back to me, I have a lot more to say. But I think for my approach, especially when I'm investing in these young disruptors, when I'm looking at, I mean, companies like Butterfly and Nanox and Upstart and these young companies that are just now beginning to prove themselves, I think position sizing is just the absolute most important thing. No matter how confident I am in their ability to execute, I could always be wrong. I turned out to be wrong today. I'm going to be wrong again in the future. So I think it's really it's imperative not to kind of go all in, not to put your eggs all in one basket, or even 15 or 20% of your eggs in one basket. For me, the most I'll ever invest in a company like this is overall capital. In Butterfly's position, because it was even more speculative, it turned out to be 1.5% of my capital, and that just really it will insulate you when we have shitty days like today. It will make it so that for me, Trade Desk gains more than cover the losses I incurred for Butterfly today. So just I think when you're embracing this strategy that I'm embracing, and you could embrace an entirely different strategy. There's a lot of different ways to do this, but I think we have to embrace that sometimes we're going to fuck up, sometimes I'm going to be wrong, and we have to own that. And I think to shield ourselves from the pain that can cause, I go back to this 1 to 2% of invested capital for these hyper speculative names like a Butterfly is, and like a CuriosityStream is, by the way. But fortunately for me, they're executing. And yeah, I'll leave it. I'll leave it there. But yeah, I'll leave it there. Well, let's move on to the next speaker. And thanks for having me, Wolf. Excited to listen to everyone.
Hey, Brad.
Absolutely.
Hey, Brad. I have a quick question for you.
Sure.
You talked about position sizing. How do you handle stocks that are speculative and they start off at small sizes in your portfolio, but you hit a home run on them or you do pretty well on them, and they grow to a bigger size than you want them to?
Sure, great question. And for me, it's really so stock divorcing from company performance kind of goes both ways. So I think to illustrate this, I'll use Upstart as a good example. So Upstart went from like $25 a share to $400 at the peak or something like that. But at the same time, their margin guidance absolutely exploded to the upside. I think a 600 basis point expansion of their contribution margin guidance, and their 2021 revenue guide more than tripled with 2022 and 2023 estimates following suit. So to me, it's very much so based on how the company is doing. So I can kind of sit on my hand. I did trim a little bit of Upstart just because it got so out of hand, but it was only 10% of the position at the top. So I'm not a genius or anything like that. But um, when there's a stock that's delivering on results, I kind of I kind of the share price more so than I do than when it's not delivering on results and on the downside. So I don't know if that answered your question or made sense, but for me it's really it's a case by case basis, just weighing how good the company is doing and what kind of multiple or what kind of forward multiple, because we have extremely low interest rates, which is always nice, that I can project and forecast. And then so for okay, and another example, I'm just looking at my holdings. A company like Lemonade went from $60 to $180 a share last year. Nothing changed about the company. The cash flow continued to be a negative, a bloated and negative. Guidance was raised not materially, and it went from and it tripled. So there I am looking to trim, and there I did look to trim because stock performance is maybe running a little bit ahead of company performance. So it's a little bit more of an art than a science, and I probably spoke for way longer than you wanted me to, but hopefully that made sense.
I think that was perfect. Definitely hit on it well. Yeah, and I like what you said there, Brad. Since we do have a great group of speakers here, I'll just ask each speaker to keep to maybe about 3 minutes to 4 minutes per answer. That way we can have kind of rapid fire come around for multiple rounds with everybody and welcome in. I think we have about 200 more people than when Brad started talking. Brad, you really brought in the crowd. That was awesome to see. We are going through some different areas of fundamental analysis. The main focuses of tonight are going to be on essentially studying earnings and reacting to earnings, as well as discussing what to look for in the three statements. For those who aren't familiar with those are the balance sheet, the income statement, and the statement of cash flows. Those are pretty easy to look up. If you go on Investopedia, you can get all the details. So I just want to keep it to solid content here. Nick, I'd love to go to you next. I know that you had mentioned similar bouncing off of that idea of earnings, that's something you wanted to talk about.
Yeah, for sure. So I'm gonna go do one specifically that I know everyone talks about. I know basically half of FinTwit is actually invested in Palantir. So this is one I have in my IRA as well. Um, and honestly, they reported great earnings. So revenue and sales beat the consensus, which is the analysts. Let's see, hold on, let me just get the exact number. So yeah, revenue was at 418 million, topping the average analyst forecast of 402 million. So that's great. They increased guidance, which is also another big thing. And I'll get back to that in a moment. I think where's the earnings per share? I know they beat that as well. Where's that? Hold on. Okay. So yeah, earnings per share, which was a loss of 102 million or 5 cents a share on revenue of 392 million, which was up from 289 million a year ago. So they basically gained 103 million in a year of revenue, and their adjusted earnings per share after it was adjusted was 4 cents a share. So they actually made profit, and that also beat guidance. So the big thing here is one, I think Palantir was too. And I'm going to go over all this stuff again, but I just want to give thoughts on why I saw many people comment on Palantir after earnings, because yes, it did report great earnings. Yes, it did guide up on EPS and revenue, which is great. That's something you want to see a big company do, showing that they believe they're going to grow in the future and they have the tools to do it. And I think yeah, Palantir increased their guidance from 30% growth for the full year to 40% this year. So that's even great as well. Now I think there's a lot of supply, meaning there's a lot of shareholders in this that have bought at high prices and stuff, and there's so many names on this that it could actually be brought down because of that. And I know I'm jumping around here, so I'm gonna stick to one point now. One thing for these big companies is obviously beating analysts' expectations and guiding up. So, for example, I'm going to go to another name here, which is Roblox. So, recent earnings of last week, um, after earnings, it gapped up and closed up 42% on the next day. Now, there's so many different layers of earnings. For example, Roblox and Netflix, most of their earnings actually revolves around, yes, it does revolve around the earnings itself, but it also revolves on daily users or subscriptions being added. And if you look at Netflix, it may have a little lower, uh, it may not do well on the earnings side sometimes, let's just say, but if they report increased subs or increased viewers and stuff, the stock will skyrocket. And there's just so many different layers to so many different stocks. It depends on the sector, it depends on the stock, and what they're basically how they make money or how they can grow their business. And for Netflix, it's subscribers. For Roblox, it's daily users and daily time on the actual service and games. um, that can cause the stock to actually be more influential on that side than the earnings itself. But let's go into Roblox here, and I'm going to focus on the earnings more in this one than I did on Palantir, and I'll go back to Palantir too quickly. So Roblox reported sales of 637 million, up 28% over year, which is great, compared with an estimate of 636 million. So they beat estimates by a million, which isn't bad, but not that great. But still, they definitely beat the analyst expectations, so that's good to see. Their revenue excluding deferred revenue came in at 509 million, which is 102% year over year, which is a great increase. And then here's the big number for Roblox. So this is the number that Roblox, kind of focuses on, and the shareholders and investors, institutional investors focus on a lot, is their daily average users. So their daily average users was 47.3 million this quarter, which is up 31% year over year, and up from 43.2 million in the second quarter. So they gained 4 million users on average every day, which is a big, push for them. And of course, if they have more users, they have more revenue possibly, as people are buying stuff in these games as well. And if we wanted to go back into Netflix earnings, we can do the same thing there. Maybe we'll do that later in the video. But now I want to go back to Palantir just quickly and go over maybe 30 seconds. So yes, they reported great earnings. They beat EPS, they beat revenue, and they guided up. And like I said, that's something you want to see companies do. So companies could beat earnings this quarter. They could beat the analysts this quarter on revenue and EPS, earnings per share. But they could guide down for the next quarter. And even though, you have to see how the reactions are for any stock. Every stock is different. But usually when they guide down for the next quarter, the stock will actually take a hit that day, or that, aftermarket or pre-market, depending on when the earnings were released, going into, the next couple of days. And obviously it shows a decline in sale, or a decline in what they were expecting for estimates on revenue and earnings per share, which can cause, the hurt to the shareholders in that regard. But like I said, I've seen stocks that, have beat expectations and guided up, and I've still seen them down. So truly, it all depends on. There's just so many factors in earnings, and I've traded earnings for over 6 to 7 years now. When I first started trading, I would actually solely trade earnings and actually hold through. I actually don't hold through earnings anymore unless it's in my IRA account. But I have a lot more to talk about, but I'm just gonna cut myself off here before I get a little too deep. So we'll go into it a little more, I guess, later.
Perfect. Yeah, those are a couple really interesting companies and great points with the beat versus not beat. And it's always a tricky thing trading around earnings. So definitely we can dive a little bit more into that strategy, but I appreciate that. I definitely want to get everyone involved in the early portion of this. So stock market news, my wonderful co-host, would love to throw it over to you because I know that you write these deep dive newsletters on earnings each week. And maybe keeping it a little bit more non-company specific, because I definitely want this to be something that people can take and relate to any company or different areas. But what does your process look like when you go ahead and you're like, I'm going to do a fundamental deep dive, on this company?
Yeah, perfect. So, first thing I have down here, and this is the number one thing that I wrote down, is don't make your decisions based on the headline numbers. That is the revenue and EPS. What's going to happen most of the time, you're going to get headline numbers come out, EPS beat or miss expectations, and revenue beat or miss expectations. I have seen countless times that they will beat, and then the company will miss on forward guidance, and then boom, stock tanks. So, and it takes, yeah, stock talk. I know.
No. Go for it. Finish.
Okay, perfect. Like, just along with it, there's every single company, every single report. We're talking earnings specifically. There's one or two numbers in there that are going to move the stock. So each stock has that. There's some that are kind of across every single company. Like revenue is going to be important, margins are going to be important, expenses are going to be important, net income's important. But like there's company specific numbers as well, whether it's Tesla and deliveries or Facebook, Snapchat, Twitter and users or whatever. So you have to go in and find those numbers. There's you can go in and find those and control F and find those really easily. A strategy to find those for every single company, find what people are tweeting about and talking about on Twitter, and then kind of backwards search it into the company filings. So step back. Every single company, they're going to report their quarterly earnings and their annual reports to their investor relations page. If you type in Google investor relations, Apple investor relations, any company investor relations, their page is going to show up. You're going to be able to find their quarterly earnings through there, and you can kind of find all these numbers. But a great strategy is to find stuff that people are talking about on Twitter. Oops. Sorry, the dog. 1 second.
It's okay. I've dealt with this.
Going
I think we
crazy
all.
out of nowhere. There's no one here too, but that's besides the point. Okay, working backwards is a big thing. So yeah, back to you have to dig into the numbers, try and find the one or two specific numbers that are going to move it. I said a couple of them. Forward guidance is always important, so you want to go and look for that as well. I know a couple people in here will, give you some better things specific to look in there. And more or less, the one last thing I want to add in, or a couple last things, is when you're looking at this stuff and making your decisions, don't just look at this quarter. Don't just look at this quarter to over year, or compared to last quarter. You really have to look at the recent trend and how it's been moving and how it's going forward. There's a lot of deeper diving that you can do around this stuff, and this is just talking about earnings. So you should have done your deep dive and know why you're fundamentally in this company. But when you're around earnings, you don't want to look at this one quarter in specific ever. You really want to kind of look how it fits into the recent trend, if there's anything different, why it's different, that type of thing. And then actually just one last thing, and you can pass it on. I would never make my decision on a company on an earnings until you hear the conference call. Normally, if it's a stock that comes out at 4 p.m. Eastern, the conference call is going to be 5:30. That is something super important that you have to be on if you are invested in the company. You can listen to it the next day if you have to, but I would not make any decision until you've heard what the CEO, CFO, whoever it is, corporate management, what they think about the quarter, and maybe some insights into why specific stuff happened. So yeah, waiting for the conference call is also another big tip that I throw out there.
Definitely a good one. Yeah, I'm putting together a little bit of stuff that I'm also going to talk about in regards to this, but let's keep it rolling with these speakers. So, Stock Talk Weekly, maybe moving away from just earnings. I'd love to hear your perspective on how you conduct fundamental analysis on a company.
Yeah, I kind of came in on the tail half of what Brad said earlier, and he covered a lot of important points. Obviously, just to give a summary of what basic tools, I think you need to understand SEC filings. You need to understand how to read a balance sheet, and that's just outright educating yourself on doing that. Whether you need to do it through YouTube or through a mentor, learn how to read a balance sheet, learn how to read an earnings report, and learn how to, conduct independent research by yourself and SEC filings. Learn how to scan an SEC filing, learn how to identify the immediate information quickly. Earnings reports is something I stress all the time about learning about because you very often see these fake out reactions to earnings reports where people don't know what they're reading, frankly, and they don't really know how to interpret it. Like, for BidF, we just saw this just now after hours. It was down like 6%, testing that $8 support. And then people kind of digested the report and they're like 93% EBITDA, record revenues up 22% quarter over quarter and like 170% year over year. Once people start seeing the numbers and digesting it, you see the appropriate response. And obviously it came back into the green. But, that's just one example. You want to know what you're reading. That sounds silly and obvious, but it really isn't for new traders. Um, Earnings reports, balance sheets, SEC filings. Do whatever you need to do to understand how to read all those three things quickly and efficiently. Because if you're going to take half an hour to read an SEC filing, by the time you're done, the market reaction is going to be over. So you want to know how to interpret this data efficiently and effectively. If you're a purely long-term oriented investor, you want to read it in detail. But still, knowing how to scan it is important. If it's a long-term position that is dipping for no reason, and you might want to buy the dip, those are the scenarios where that'll be beneficial to you to be efficient with your information. But just on a stylistic perspective, this is something I think that is simple for new traders to do. It's something that I do very often, on my page and in general. Today TRT, which is one stock we talked about, is an example. What I do is I do a top-down approach when I trade or pick the tickers that I trade. So I identify sectors that are hot or sectors that have had big runners. The whole sector doesn't need to be hot, but if there are big runners in the sector that have, you know, 5, 10, 20, 30x their market cap in a matter of months, to me, that screams sympathy trades. To me, that screams there's got to be other players in the sector that are not trading up to par on valuation based on this outlier or based on the if the entire sector is hot based on that theme. So TRT, I'll give that as an example just to be to give people context. But TRT was a company I found, semiconductor burn in. I found them last week, did a lot of work this weekend, did not expect the today. So knowing that it moved big today, that was not something I expected. But I looked at them and I looked at another stock, AEHR, which some people might be familiar with. It's up like 1,600% in the past year, and it's up 900% since just July of this year. It's a semiconductor burn-in and testing stock. There's very few on the markets publicly that are focused on semiconductor testing and burn-in. So I found TRT and I said to myself, why is this company trading at a 19 million market cap when a direct peer is trading at a 650 million market cap, is on a plus 1,600% 1 year run in the stock, has negative EBITDA, and this is all about AEHR, negative EBITDA and 16 million in revenues. TRT had well over double the revenues at 36 million, was EBITDA positive and doing the exact same thing. So to me, it screamed, there's a trade to be made here on the fundamental value. So, I wish I had added more before that dropped. I didn't, but I bought the dips today on the first dip down to 590. It closed the day at 670. It ran as high as like 785, 790. Explosive run today as buyers poured in, but they poured in because they posted, a 23-cent net income versus zero last year. In a space that's obviously heating up, which is semiconductors, and these low float small cap plays, like AEHR, they're trading now at 40x sales. AEHR is. TRT trades at 0.7x sales. 0.7x in the exact same sector. It makes no sense. So when I'm using fundamental analysis mostly, and this is an exception to the cases in my long-term investments where I do a much deeper form of fundamental analysis. But from a trading perspective, I'm looking for sector themes or big runners, and I'm finding fundamental lapses in value between peers that I think are exploitable or I think are buyable. And then I buy those stocks and I wait for the market to find them. Now, granted, it's not always going to be on the same fucking day like it was with TRT today. That was just because they dropped a surprise that was supposed to be reported on the 26th. They dropped it this morning for some fucking reason. I have no idea why. But but barring those situations, getting in early on these plays can be really beneficial because you can get these multi-week runners where you're in at, $5-6 and the stock runs to 20 or 30 bucks. Those can be life-changing moves depending on how much size you put into these trades. And so that's the kind of trades I look for, and that's really where I use fundamental value. I use it as a tool to find exploitable opportunities. I don't so much use it as a tool to assess companies unless I'm assessing companies that I'm invested in long term, which there are a handful. And I'll use it as a tool to assess them in the cases of their earnings reports or changes in their business model or operational structure that may affect their ability to generate margins or their ability to generate free cash flow, whatever it may be. Those are case by case. But for the most part, I'm using fundamental analysis as a tool to find exploitable opportunities or lagging stocks in the market. That's mainly what I use it for.
Fantastic points. And so two things on that. So one a point and then a question for you. So the first one is to people in the crowd. I guess if you didn't have a financial background, some of the terminology may be a little bit strange, but a lot of it's pretty easy to find on Investopedia if words are said like EBITDA and others, which I think are pretty commonplace. But you can dive into these. I'm sure a quick 30-minute video on YouTube can walk you through, what is the balance sheet? What is the statement of cash flows? And you'll get to learn some of these things like what is GAAP versus non-GAAP. I don't think it's like super helpful to give full explanations on these spaces, but definitely I recommend these are things that you dive into. And if you do have questions, just DM Brad. Sorry, Brad. With that,
I keep cutting in and out, so I'm not sure if you just came to me for a question, but I'm sorry if you did.
no, you're good. You're good. I tell people to DM you if they have fundamental analysis questions.
Oh, sure.
Uh,
Open all the time.
There you go. And then stock talk, I wanted to come back to you. So you mentioned the multiples there and how what you're doing is you're often looking for a company that is perhaps in the similar regime and just trading at a lower multiple. So which multiple specifically do you pay the most attention to?
Depends on the industry, but with these emerging sector stocks or smaller cap stocks, I'm really focused on the sales multiple because I don't expect a lot of them to be profitable, especially these growth companies. So I'm generally looking at the revenue or the sales multiple. For more mature companies, you want to be looking at, EBITDA multiple and other, more sophisticated scopes on the stock. But when I see companies that are at a severe discount multiple wise, especially with these smaller companies, and then I also see that they have a key differentiator. Like in the case of TRT, they are EBITDA positive, however slightly. It's only by a few $1,000,000, but they're EBITDA positive while AEHR, the competitor that's trading, at 40x sales, is EBITDA negative. And when two companies are doing virtually the same thing, that really heralds me to be, asking myself, why isn't this trading higher? And that's the beauty of the markets being inefficient. Everybody always says some people say the markets are efficient, some people say they're inefficient. They really are, in my opinion, very inefficient. And that's the beauty of it, is because you can identify these value gaps, and sit on them. Like, I'm sitting on TRT comfortably, even after the run today. I'm not out of I have a large position because, whether tomorrow could it be, it ran, how much did it close today? It closed up 35% today, right? It ran as far as like almost 60%. But, for me, it's a low floater. If a few institutions come, it's a 2 million float. If a few institutions come and buy up, 5, 6, 700,000 shares and hold them, you're reducing the free float by another 5, 6, 700,000 shares. You can reduce it by a quarter instantly. So this is the kind of like what I call a powder keg play. It's risky and it's volatile. Today when I was tweeting about it, I was telling people who were tempted to chase it, I was like, look, this is a low flow play that is going to whipsaw. I mean, we saw it whipsaw today. It ran to 780s and then dumped all the way down to the 650s, right? Like, these are volatile plays, but for me, it's a swing because, as long as AEHR doesn't come down, which it doesn't look like it is coming down, if AEHR is trading 650 million at 40x sales, I don't see why this can't trade higher, a lot higher.
Great points. Yeah, definitely. That's one of the strategies which I've seen multiple times be correct, as you pointed it out, where you said, hey, look at this, it's way overvalued. Here's some other plays. And it's often great when you can find that industry that you love and then dig inside that industry.
Yeah,
Really good
just a
points. And
quick
that's
point on
where,
what you said about overvalued. That's the beauty of it, though, right? Like, when you're looking at fundamental analysis on its own, right? If you're just looking at a company in a vacuum, you are forced to make that assessment. You're forced to make the assessment, is this company overvalued or undervalued? The beautiful part about fundamentally sympathy trading, like what I'm doing, where I find a peer and then find an undervalued peer, is you're just taking the market value for what it is. So you're pricing the primary runner as, hey, the market is valuing AHR, for example, at 650 million bucks. I don't have to make the assessment, or I'm not forced to make the assessment, is that company overvalued or undervalued? Instead, I'm simply forced, or not forced, or I'm simply, encouraged to find other peers that aren't yet trading at that multiple and assuming that the market will drive them higher. And it typically works. Most of those fundamental peer gap plays I put out, they almost always work. Not because I'm a genius, but because it's, it's an inevitability in most cases, and in certain cases that primary runner or that theme might die out and that primary runner might come crashing down. And yeah, in those cases, it won't happen. But when the primary runner is sitting up 1,600% over the course of a year on a straight rip run, you got to expect at some point the market comes to find other ones. And, I always tell people this about penny stocks. Every stock is, or a lot of stocks are penny stocks until they're not. And, these kind of runs are what can take a company from, people looked at, when I was talking to some of my friends about TRT this weekend, and I was telling them, hey, it's trading at 19 million bucks. Some of my friends were like, I don't buy companies that small. And one of my friends that said that was somebody that owns AEHR. And so I asked him, but I said, in July, AHR was that market cap. And you just because you bought it a couple $100 million more expensive, did that make it a more virtuous play simply because the stock was running? Nothing fundamentally changed about the company. So that's the thing, is rather than chasing that primary runner or buying the primary runner, there's this illusion in the market where people think that because a stock has gone up significantly, that is proof in the virtue or the value of the stock. That is not true. What instead I do is, rather than chasing the primary runner or trying to find a spot on the main train, I get a bottom out entry on a sympathy and ride that instead. Way lower risk and generally way more consistent reward.
Yeah, that definitely panned out really well there. And it's a great point what you were saying with the fundamental analysis in the vacuum, with having to go and decide whether that company's undervalued or overvalued, and then sympathy trading off of that. It's a really interesting strategy. Okay, let's keep the ball rolling. And if you're enjoying this, if you're hanging out, this panel up here, just quality speakers, people that understand both the fundamentals, definitely some technical traders up here as well, trading a lot of different types of stuff. So, Stock Talk Weekly, Brad, Nick, you've already heard from them. Oh, and Evan, of course, Stock Market News. Make sure that you're following all of them, and you're going to hear from the rest of our speakers right now. So, Unhedged, let's throw it over to you. I know you have a whole platform to this. You're a big fundamentals guy. You reached out to me about this. Would love to hear from you about your strategy with fundamental analysis.
Yeah, sure. So my background, I did fundamental investing at hedge funds in the 2000s. I was at Greenlight Capital. Did a lot of work with Third Point Capital. Did my own fund, and then I started building on Hedged, a platform for fundamental equity research. Over the last 20 to 30 years, the markets have gotten dramatically more efficient, and even what I used to do 15 years ago doesn't work today. In terms of when I was at Greenlight, we did a lot of accounting analysis and financial statement analysis to identify fundamental investments. Also, a lot of rigged trading where management teams would get um, stock options, and we knew that they were setting the timing and value of the stock options because they knew they were going to have a great 1, 2, 3 year run, and the stock was going to double or triple. Those were very easy things to do back then that most people know about now, and they don't work anymore. So I thought I would kind of talk about what does work, and to echo what a lot of the other speakers said, the start of any research needs to really be the annual report, the earnings release, and the most recent earnings transcripts, all of which are on Unhedged, of course. We are primarily focused strictly on qualitative research, qualitative information. So what works today, and when you look at some of the more successful funds over the past decade, whether it's Tiger Global or Cotu or a Treaties Management, which is a rapidly growing firm in Boston, what's working now is taking a longer term view, 3 to 5 years, sometimes longer, and figuring out where the company is today and where it can go if they execute well. And before you start that process, you've got to take a step back and think about the nature of the business. And what do I mean by that? Some businesses are cyclical, some businesses are what's called secular, meaning it's going to persist. Um, and understand the nature of the business to know how predictable and confident you're going to be in the future results. So, for example, with Unhedged, we do usually a weekly stock idea, and we did one on CF Industries, which is a cyclical company, meaning that their profits um, ebb and flow every 3, 5, 7 years with market cycles. In their case, they sell fertilizers, and the price of the product they sell is $600 a ton now versus $200 a ton 6 months ago. But the cost of making that product didn't really change. So their margins can go up astronomically because let's say the cost to make a ton was 150, they're selling it for 200, they're making $50. Now the cost goes to 600 and it still costs 150. Now they're making 450. They're making 9 times more money for doing the exact same thing. So that would be extreme cyclicality. Another thing would be whether the items being sold are a durable good or a non-durable good. And what does that mean? Things like autos, real estate, those tend to have cycles because consumers don't buy them very often. Cars, people buy every 3 to 5 years, houses, even less frequently than that. Whereas take something like, software right now has got quite a business model with software as a service because people use software every day and you're effectively getting billed every day. A site like Facebook has very high visibility into their revenue. You would not be going out a limb out on a limb to say 12 months from now, almost no matter what happens in the world, Facebook's revenues are going to be similar or higher to what they are now. Same with most SaaS companies. When you're looking at John Deere, a tractor manufacturing company, the sales next year could be 25% higher or 25% lower based on what happens with the corn and soybean markets. If farmers feel poor, no one's going to buy the products. So, in that light, you got to look forward. So, CF Industries was the cyclical fertilizer stock. That one's kind of easy. I knew the market wasn't paying attention. I'd done a lot of fertilizer work already. You read the annual report, you figure out the unit economics, you figure out the markets they sell into and how those work. And then when you see the profits are going to be 10 times higher this year than last year, and the stock hasn't moved, that one's a little bit of a layup. Another person today asked me about a stock called NICE. NICE is the ticker. I don't know much about it, but because I've been doing this a long time and I think I have a framework now in place, I looked at the company and I saw they were doing something software related. And I said, look, these are the 5 questions you need to know whether or not this is going to be a successful product. The first question is the nature of their revenue recurring? Like in the example of Adobe or a software, Microsoft, revenue is highly recurring in nature. Question 1. Question 2, there's another concept in software called net dollar expansion rate. That means for a given customer today, are they going to be spending more money or the same or less money with me next year? Mature products like a Microsoft and things like that, well, pre-Azure anyway, there wasn't a lot of net dollar expansion. But when you get a high growth company that's adding lots of products and features all the time, like a Twilio or a Mongo database or one that Austin Hankwitz and I did a video on a couple of weeks ago called Amplify. Well, it turns out the existing customer base is spending 20 to 30% more per year every year. So you got 2 different levers there growing your revenue. You've got existing customers spending 20 to 30% more every year, and you're growing the existing customer base 25 to 50% a year, which is like Snowflake as well. So when you get those, you try to think about where can revenue go if they continue to execute like this. Of course, you've got to talk to management, get comfortable with the game plan, think it's reasonable, etc. So in the case of this NICE company, are customers spending more money with them every year, the same, less? How recurring and sticky is it? I noticed their operating margins are only around 15%. That was another very lucrative trick 15 years ago that is harder to do now, but it still works really well with software in particular, is margin expansion, which is exactly what CF Industries is doing right now. It used to be that if you had a company with only 2% profit margins, it got a low multiple because people thought, oh, it's not very profitable, this company sucks. When you have a low margin and you have the ability to expand that margin, it's very easy to rapidly double, triple, quadruple the earnings number. You can easily 5x a 2% margin company by having the margins go from 2% to 10%, and the earnings go from $1 to $5 per share. And if it was trading at a low multiple, the stock might have been at $15. Now it's got $5 of earnings, and people think it's sexy, so maybe it's got a 20 times multiple. The stock goes from 15 to 100 just like that. I mean, just like that over the course of a year or two. But that's where you find really big winners. Similarly, with this NICE company having only 15% margins, the question is, well, ask the management team, what's the plan here? Where is revenue? What range can revenue be in 3 to 5 years from now? And there's a concept called incremental margins, which means for every dollar of revenue I add, what's the amount that flows down to the bottom line aside from overhead? And that's incremental margin. So long term, growing companies tend to have the absolute margin trend towards the incremental margin. And a lot of software companies have incremental margins in the 40 to 60% range. So if NICE can grow their revenues, let's just pick a number, 15% a year for 5 years. So maybe revenues twice as high today. And maybe on that plan, the margins go from 15% to 30%. So if revenues are 100 today at a 15% margin, they're earning $15. And if 5 years from now, they're going to have double the revenues at double the margins, those earnings are going to go from 15 to 60 because 30% margins on 200 is 60 and the 15% margins on 100 is only 15. What I just described right there is exactly what Tiger Global, Cotu, Atreides, the best tech and consumer investors, that's exactly what they do. And another good example recently in the consumer sector would be Chipotle. Chipotle was doing, I think, $2.5 million of revenue per average restaurant. They started rolling out drive-through and delivery, and the CEO got on the phone and said, "Hey, we've got 7,000 locations, whatever it is. The average one does $2,500 or 2.5 million of revenue. When we add delivery and drive-through, the revenue per store goes from 2.5 to 3.5 to 4, and it's higher margin for various reasons." And then he says, "Well, all 7,000 of our restaurants, we're going to roll out drive-through and delivery in the next 12 months." Well, now you've got a model. You can take 2,500 or 2.5 million times 7,000 of units at, I don't know, 15% margins. We know that when they roll all this shit out, they're going to go to 3.5 to 4. Just be conservative. Take 3.5 million times 7,000. And then you know that the margins are going to be a little higher too, because you get a lot of operating leverage in a restaurant when you're doing more and more volume. That incremental margin is helping raise the overall margin. So revenue per store goes from 2.5 to 3.5 million, and margins go from 15 to 20%. Sure enough, Chipotle stocks, I don't know what it's done. It's probably doubled this year as they've executed this. So, the fundamental frameworks of how to think about businesses, revenue stability, revenue predictability, that gets into competitive positioning and all that, customers, suppliers, blah, blah, blah. And then margins and operating leverage. That's the gist of fundamental analysis. And on Unhedged, that's what we focus on, providing tools and analysis to help people do the qualitative research to understand the levers and mechanics of all these various businesses.
Now that was really good stuff.
Cool. Thank you.
That was, yeah,
What
that
happened?
was
I blacked out.
fantastic. No, we got that all in recording. That was perfect. That's it's the clip and cut right there. Amazing. Yeah. Well, thank you so much first off for coming in. Definitely, I had the opportunity to see your platform displayed down at FinToy conference, and the data that people are able to do in there and the fundamental analysis they're able to do. And if anyone wants to check out Unhedged, I'm sure there's a link inside the bio that you can go ahead and just take a look at. My one follow-up question to you there is discussing the margins. And if I guess I just wanted to, is there a typical amount of margin that you're looking for? And I'm sure that varies by different situations, but maybe is there a couple different situations that you can outline where there's a certain number that you're looking for?
Not really. Every situation is situationally specific. Different types of businesses have different levels of capital intensity, different margin profiles, different lever points. Like the earlier speaker said, sometimes it's really helpful to compare two peers in the same industry and say, one of them has 2% margins, one of them has 15% margins. Why? A great example of that, which Austin Hankwitz and I just did a video on with Unhedged, is Arhaus just went public, ARHS, and Restoration Hardware has been public for a while. Restoration Hardware has been a grand slam. Arhaus is trading at 1/10 of the valuation. So, I'd never looked at Restoration Hardware. I never looked at Arhaus, but I know how to analyze retail, unit economics, and all that. So I pulled them up and I said, okay, let's compare their store counts. Let's look at their revenue. Let's look at the revenue per store. And then let's look at the gross margins. Sure enough, the gross margins are actually very similar, but Restoration Hardware is 3 times more profitable per store. Well, why is that? It's because they're doing 3 times more revenue per store. When you're doing more revenue per store and you see the gross margins are very similar, the reason the profits are so much higher is because they're getting a lot more revenue per employee inside that store because they're selling so much more. So maybe they're both staffed with 100 people each, whatever the number is. When you're doing 3 times more revenue on the same cost base, that's when you can get that explosion of profit margin. So the natural question with Arhaus is to go to Arhaus's management and say, hey, your direct competitor is doing 3 times more revenue per store. What's your plan to try to bridge this gap? And then you can presume as they bridge the gap, the margins would go up. And if somebody gets to the bottom of that, I don't have time because I'm busy building Unhedged. But if I were looking at that, that's exactly what I would do and talk to Arhaus, then assess, does it sound like their path and their plan is reasonable? And if it is, and they're going to 3x the revenue per store, then the stock's going to go up 10x over the next 5 years. So that would be a very attractive situation, assuming they have a credible plan, which I honestly don't know the answer to that.
Good stuff. Appreciate that. Yeah, it's definitely a case by case basis. Awesome. Yep. All right. Luke, let's get you in here, man. Appreciate you being patient. Would love to hear from you.
Cool. Thanks, everyone. I got to hop.
All right, take
Yeah.
care.
Thanks. Bye.
So yeah, thanks for having me. So long term, I'm a fundamental investor, and short term, I'm a technical trader, and that's kind of my gig. So when I'm looking for investments, really my overall thesis, the preface before I get into what I look at, is I like to invest in best of breed names within industries that I see a lot of growth in the future for. I keep it pretty darn simple too. So the first things I look at are management, business model, industry, and then when we finally find a company and I look through those things, I also look at where a company can add value or other areas for growth that they could possibly go into in the future. Those are all things I look at almost right away. And then I move into the balance sheet, and I keep the balance sheet quite simple at first. I simply look at their total assets, total liabilities, cash and equivalents, and then typically debt levels over the past, say, 12 quarters. It depends on what company I'm looking at, but I like to look at trends. That's kind of my thing. Not only do I look at the technical trends, of course, but when it comes to fundamental analysis, I like to look at the trends of these earnings metrics and also balance sheet metrics. So I kind of look at the long-term trends of all of these levels. So for instance, we brought up earnings reports. So when I take a look at an earnings report, I don't only look at the latest one, but I also look at the past and previous few. And then typically within those earnings reports, they go back 4 quarters. So you can put these together, and there's other areas where you can get correlated data over a longer period of time for these metrics. But I look at, for instance, earnings per share, gross profit, gross margins, operating margins, net loss and or income, depending, cash flows, operating income or loss. I look at all of those things over a long period of time. Now, given the way I use fundamental analysis, and really it's for long-term best of breed names, I'm more looking at these trends. I'm looking at these trends and whether they stay positive and to the right. I That's simply what I do. I keep it simple, and no company's perfect. So eventually you're going to have an error, possibly at once in a few of those areas. You're going to have a certain quarterly report where something goes wrong or a metric comes out at a level that you simply didn't expect it to. You simply don't appreciate the level. It misses the mark. So then I shift into analyst commentary, and I dig into that analyst commentary, and I figure out, okay, did not analyst commentary, management commentary. I apologize. So I dig into that management commentary, and I don't only read their preview of the quarter that they just reported or previous quarters, but I also look at what are the issues that management ran into throughout the quarter. Why did they miss? Say, why did operating margins come in at a level lower than what was expected by management? And I like to see where was the issue? What did management cite? And that's really where I go when it comes to an earnings report. You also have EBITDA. I also look at that. I forgot to mention that one, adjusted EBITDA. But also, I look at guidance. So I kind of take a whole view. I don't only look at the balance sheet or cash flows or an income statement, but I look at everything. Not only for the long term, but in an earnings report, I look at almost a very general view of the earnings report, but I also look at a lot of the, operating margins and gross margins. I don't look at one specific metric, is what I'm attempting to say here. So at the end of the day, I'm looking for trends within these earnings that are up and to the right. I'm looking for consistent year-over-year improvement over a long period of time in best of breed names when it comes to the fundamentals. And that's really what I do, and I keep it simple. And that's how I like to look at a company. Now, as I mentioned, there's going to be issues over a long period of time. And if you're a long-term investor and management notes why there was an issue and that they are working to fix it, or say that it was some uh, some expense that came up that was not expected or was a one-time thing, that's understandable, and you overlook it, and you take that in and you're like, okay, it's a one-time thing, it's not going to happen again, or it could happen again, but it's not an everyday type thing. And that's really what I look at. So, when it comes to, say, an individual company like AMD, so I'm continually looking at their quarter. Every time they report an earnings quarterly report, I dig into that report and I look at those levels. I look at the earnings per share, the revenue, the gross profit, the gross margins, the operating margins, the net loss or income, which it's all pretty much net income. I look at cash flows, operating income, and I look at all those levels and I like to see the long term trends on that type of a name. AMD is one of my holdings. So pretty much what I check in their quarterly reports are these key levels that I mentioned, which is pretty much quite a bit of the big time important levels you look at or you brief over when you quickly go through an earnings report. And if those trends continue to be up and to the right, I like it. And if I see one that's out of line, I check and I go into the commentary of management and I say, I read and I figure out where that issue was. So, really, to me, when I use fundamental analysis, it's for the long term, and I'm looking at trends within earnings that are up and to the right that are overall positive. Now, it also varies by company because you also have to account for some of these things. A newer growth company that you have a long term view on likely isn't going to be turning out a, you know, crazy profit right off the bat. They're probably going to be running a loss, which is not uncommon. So you have to take those type of things into account. There's a lot of things to account for depending on the type of company, what industry the company is in, business model, etc. But overall, when I look at fundamental analysis, I use it for the long term. I look at trends within earnings, and I also look at management trends. So when I look at a management team, what do I look at in a management team? I don't only look at experience, previous experience, but I also look at how has the management team acted, say, over the past 2, 3 years, maybe even 4 or 5 years, and has that management team been aggressive? I like aggressive management teams that are willing to go into other areas of growth. Not only, if it's a big time company and they are focused, I also like to see that they're aggressive in opening up other revenue streams, is what I'm attempting to say here. So I like to see that aggressive action out of a management team. I like to see a management team that is willing to advance, that is willing to not only continue to grow, but to find new areas of growth. I like to see that in a management team. I always look for that. I look for a management team that's open minded, and I look back and you can find those management teams by simply looking at their previous actions and the direction of the company. So I also look at that when it comes to fundamental investment. But that's really how I use fundamental analysis. That was a lot in a short period of time. But that's really what I look at. So, you have to, I take a very broad approach. I look at a lot of factors. Um, and I, in essence, come down to a conclusion or a summary, and I determine whether the majority of those factors are net positive. And if the majority of those factors are net positive and they fit the criteria that I have set on a personal level, then it's probably a solid investment for the long term, and I'll work on initiating a position. But that's kind of how I operate. I also look at valuation. You can't leave that out. You don't want to go in depending on the company, and where the company's at which stage it's at. Sometimes a company is very overvalued and you don't really want to jump in on that company right away, especially if it's a company that's been around for quite a while and all of a sudden they have this mega run out of nowhere. That's not unknown. That's not it's happened before. Maybe you want to give that company a little bit to cool off. Maybe you want to wait and then initiate a position because you simply recognize that it's overextended. But then you're getting in the technicals. So that's really where I come from when it comes to fundamental investing, fundamental analysis. To break it down very simply, I look at earnings trends. I look at trends within the balance sheet. Are those total assets and total liabilities um, you want to look at consistent trends there as well. Or do those assets consistently outpace those liabilities? I look for that. I look for a pretty consistent level in cash and equivalents. And if that changes significantly, typically there's a management note about it within the report and what are they doing. Why did you see a decrease or a major increase in cash and equivalents? I typically pay attention to that as well.
Really good stuff there, Luke. Luke is always putting out full fundamental deep dives. I post them directly to Twitter, directly to the Wolf app as well, and I highly recommend checking them out. He's a really, really good follow with everything that he's doing. Okay, so we've made it through kind of the initial round with all of our speakers. I have a couple of follow-up questions that I want to throw out there. Additionally, I'm getting some DMs. This space is being recorded. If there's a name that you wanted to hear back again or a certain part, anything like that, if you go to the link in my bio, you'll see links to YouTube, to Spotify. That's where I post all the recordings, so you can check them out on there. And I also post them to Twitter. So as long as you're following, you will see those come up on your timeline. With that being said, Brad, I want to throw it over to you, and then I have a couple questions to go around. So I know somebody had already put out a question. If you want to answer that one, the one that they tagged both of us in, you can touch on that. And then my other question for you was, how do fundamental analysis, how does it differ when you're looking at different size stocks, basically going, small, mid, or large cap?
Sure, I'm going to handle those in reverse order actually. So, in terms of what I'm looking or where on the income statement I'm looking, it's not so much how big or small it is. I mean, we have companies IPOing really early on at 70 or $80 billion, but it's kind of me gauging where I think management thinks they are on their maturity curve. So again, it goes into I don't use sales multiples because to me, anyone who has cash on their balance sheet can spend $1.95 in business, and to me that revenue growth is not attractive. But I do look at as closely to that top line as I possibly can for these younger, newer, higher momentum companies. So I talked about gross profit margin as being kind of my go-to metric as these companies are sinking all of their operating profits back into the company, back into growth and market share. So at that point in time, it really doesn't make sense to be looking at earnings because they're not trying to earn anything, and gross profit margin again gives that really good sense of how much they could be earning if they were trying wholeheartedly to earn money. So that's really what I'm looking at. So it's how early I think they are on that S curve that everyone talks about on that growth curve. And then for those really young companies where I'm looking at gross profit margin, I'm not looking for free cash flow or net income, but I am looking for those margins to be improving and heading towards zero, which just shows me operating leverage in the business and that the company is able to generate growth again without just sinking more and more money back into the business constantly. But answering the tweet question that we had in the middle of the spaces, which was a great question on Curiosity Stream's competitive environment, and I would answer that with two things. So, first of all, Discovery's founder and CEO or old CEO John Hendricks, he is the founder of Curiosity Stream. So he really saw the Discovery Channel as pivoting and diverting from this pure factual focus and towards reality TV and more scripted content. And to him, and I agreed with this overall sentiment, that left a void in purely educational and factual content that Curiosity Stream is really looking to fill. But at the same time, I mean, dauntingly competitive environment. They're not Disney Plus, they're not Netflix, they're not even Viacom, they're not any of these players. I think they've got like $100 million on their balance sheet versus tens of billions for all these gigantic players. So they're really leaning into this scripted niche to lower content costs. So the stat that they often cite is their scripted content costs about 5%, their factual content costs about 5% of the production costs of a big time scripted production. And what they're doing is they're really using this to grow more so than their direct to consumer channel. They're using these really cheap production costs to bundle with the Spiegel TVs of the world in Europe and Tata Sky Binge in India for fractions of a dollar to be part of their bundles to grow subscribers that way. Because again, they are very new, they are very young, they don't have billions of dollars on their balance sheet, and they do not have the brand equity of these really really powerful deep pocketed companies. So great point that competition is fierce, and those are really the two ways that Curiosity Stream is trying to sidestep this competition and really differentiate themselves.
Perfect. Thank you so much, Brad. Love that. Okay, Stock Talk Weekly, throwing it over to you. Um, how can fundamentals be combined with technicals for optimal investing performance?
Yeah, I think optimal trading performance is really what you mean to say. For me, I stay away from the notion that people can't be traders and investors. I think you absolutely can. For me, I have three different accounts. two of them are trading accounts. One's a pre-market trading account, and I trade more penny stocks on it, and the other one's just an equities trading account, and then I have my long-term account. My long-term account, the way that I act and make decisions, and I manage my positions is dramatically different from how I do it on my trading accounts. On my trading accounts, I'm looking for volume, price action, themes, sympathy trades, day trades. I'm a whole different animal on my trading account. On my investing account, I find companies that I believe, my number one decision making process on the fundamental side for my long term account is I find companies that I believe have an intangible competitive advantage, whether that is in technology, certain intellectual property or patents, brand recognition at times, ability to penetrate multiple verticals, access to additional verticals that competitors may not have. All of these things are things that I look for when I'm looking for long-term investment. Because when I'm looking for long-term investment, I want the company to have a direct and inevitable path to appreciate outright, regardless of the operational hurdles they may have in the way, or the restructuring hurdles they may have in the way, M&A, things like that. I want those to be a smaller part of the equation than the central story. It's the same reason I bought Tesla in 2016. That's like, I would say investment wise, that's not my greatest trade ever percentage wise, but investment wise, probably my best investment ever in terms of return, because I didn't buy it because I thought the fundamentals were jumping off the table. I bought it because I felt that they had an intangible competitive advantage and were a first mover in what would be a historic industry. And just over the last 2 years, we're finally seeing that narrative be fulfilled, that electric vehicles are really going to be one of the most historic industry turnovers we've ever seen. But I digress on that. My point really is that for me, when I'm looking for long-term investments, I'm actually looking way beyond the balance sheet and the earnings reports. I'm looking for like discernible, competitive advantages that I'm confident in. Whenever I think about a company's competitive advantages, or their IP moats or any kind of moat, I'm always thinking as hard as I can, like, what could invade this moat? What makes this moat not defendable anymore? How easy is it for competitors to invade or interact with this moat? That's like my priority line of thinking when I'm thinking about long-term investments. When you're talking about combining, more to your question, we're talking about combining technical and fundamental thinking. For me, my biggest winning trades, trades that have returned 1,000, 1,500, 2,000% in short order, it's because they line up technically. I think the technical setup is good. So I analyze it purely from a technical perspective, and then I analyze it purely from a fundamental perspective. And to me, the best trades are the trades where you can say, hey, not only, what you'll hear from technical traders often is this setup is good and it has room to run on the chart. That's what technical traders will say often. Fundamental traders will say, hey, this is undervalued in the market cap and it has room to run, right? When you combine the two and you say to yourself, hey, this play has fundamental value versus peers, whether or not it has intrinsic fundamental value on the balance sheet, right? Again, that is a more difficult thing. When I'm trading, I don't put that burden on myself. I wouldn't be able to execute trades on a daily basis if I was doing a full valuation model on every company I was trading, right? So the time frame's not there. So from a trading perspective, I'm looking for fundamental, cues. Hey, is this undervalued versus a recent runner? Is this undervalued versus the rest of the sector? Is this undervalued versus a key peer that's closely related? Is this undervalued based on a sympathy catalyst that sent another stock running and this one should have moved too? Like, those are the, tidbits I pay attention to. And if you combine that with technical analysis, and you decide, hey, this is a good entry for this stock anyway, regardless of the fundamental thesis. If you're like, hey, stock is bottomed out on the chart, it has a lot of range, it has a history of big runs, maybe the sector's hot on top of that, whatever it may be, maybe there's a volume ramp on the 1 week or the 1 month that you're looking at, you see a steady influx in volume, maybe the flow is in your favor. You could look at so many different things to decide a trade. But another thing I repeat all the time is the more data you have, the more likely your trade is to be successful. And it's the same way with combining technicals and fundamentals. I would say most of my friends are either technically focused traders or fundamentally focused traders. I try to be both. So I try to find, know how to chart levels, understand technical indicators, what they're telling me, because I even believe this, if you're purely an investor, which a lot of people are, if you're purely a passive investor, or even if you're an active investor, I hear a lot of times from investors like, oh, I don't trade the chart, I just trade fundamentals, or I just trade value. And like, that's fine, but wouldn't you want to give yourself better tools so when you are buying the dips, what are the appropriate dips to buy? Or when you are, looking to trim into strength, when the appropriate times are to do that. Like, learning both benefits, or even if you're a fundamentally focused investor, knowing technicals is going to benefit you immensely in the long run, especially if you're doing this regularly, because you're going to find better entries, better trims, better dip ads. You're going to know after an ER sell off, should I be adding now or should I be waiting another 6% for the gap to fill? Like, these are things that you will know if you learn technicals. And if you're purely a technical trader who's just getting into trades based on the chart, can it work? Yeah, there's tons of traders who do purely technical, right? It can work, but you're just better equipping yourself by also knowing, hey, I think this chart has range to 30 technically, but fundamentally, does it have range to 30? At 30, would the market cap become unacceptable to the broader public? Like, these are things that if you consider, you'll have a better lip on your trades. You'll be able to call tops. You're looking at both things. If you think a stock has room on the market cap and on the chart, and you know how to determine that, those are the trades at 20-30x in short order. Like, those are the home run trades where your technicals and your fundamentals line up. So how do you combine it? You can combine it in a million different ways, but it's something that I emphasize that everybody does. People get pigeonholed their whole investing and trading careers, and they just ride one wave. They're like, I'm an investor, I'm a trader. I think it's beyond silly to classify yourself as either. There's skills from both schools of thought that are remarkably beneficial. Even if you're just a trader, there are investing principles and you know aspects of fundamental analysis that will aid you immensely in knowing what is the company I'm trading even worth. And it'll prevent you from getting burned on things like ER drawdowns, and there's a million things. I could talk about this topic for hours, but I strongly emphasize people, if you are one or the other, if you're the FA or TA kind of guy or girl, learn the other one. Trust me, is you'll be laughing at how much more profits you can make doing it that way.
I fully agree with you. It's something, I started out more fundamental based, and then, leaned into technical more recently. And now I'm trying to complement that as well with option flow and volume and things along those lines. And I find that just having the full picture makes me a lot more comfortable with the stocks that I'm purchasing or options that I'm purchasing. And in turn, it allows me that even when there's a drawdown down or something along those lines, that I can, have the confidence, because if you didn't really have the confidence in the play, you shouldn't be making it. If you're going to, not, I'm not saying you get stopped out, that's one thing, but if you're just, down on it and stop believing in it because it went down a few percent, that I think goes to show that you didn't really put in all the research up front. So being able to complement your research from multiple perspectives is really important. And, if you're interested in the technicals, I'm doing a full technical analysis space tomorrow. I'm doing one at 2 p.m. and then another at 8 p.m. So we're definitely focusing on those as well. But the fundamentals, I think, are a great starting point. So props to you, Stock Dog Weekly, for being able to mesh those two successfully, because it's not easy to do. As much as I say it's helpful, it's not easy to do.
You have to pick
All
and
right,
choose, right?
Nick.
Because you're not
Yeah,
going to get time. You're not going to get time to do. If you're a trader, you're not going to have time to do a full valuation model on every company, every ticker you buy. So knowing that, you have to pick, aspects of fundamental analysis that the market immediately looks to. Those are things like sales multiples, EBITDA multiples. What are the gross margins in certain spaces that matters more, in other spaces it matters less. Like, knowing the sector you're trading and knowing why individual components of the fundamentals matter is also massively important.
100%. All right, Nick, I want to bring you back into this. We had talked about some specific earnings beforehand, but I was wondering if there's more, applicable, I guess, to all areas of fundamental analysis or all companies, topics that you wanted to touch on.
Yeah, I mean, there's so much. So what I kind of want to go into just a little bit here is I was kind of focusing on, specific companies before. But, I kind of want to go how I kind of traded earnings a while back, and kind of just how I see them now. Um, so, like I said, I previously, like when I first started trading, I would trade penny stock earnings basically. anything under $20. And so here's how I'd kind of do that. And I mean, honestly, you could really do this for larger companies too. Um, and you could go long term on them, if you want to do that as well. But here's how I found, some big plays. For example, I used to trade APPS uh, when it was around $2. I didn't hold it long enough for, the $80 to $90 move, but I found it. I found it pretty quickly at the bottom. Sadly, like I said, didn't hold it for that full move. But things that I see in that I focused on was trading companies that were growing. Obviously, uh, very simple there. But what I was focusing on with these penny stocks is focusing on companies that, of course, are growing revenue wise, and of course are growing EPS wise. But companies that are on the brink of kind of going from a negative earnings per share to a positive earnings per share. So basically coming from a loss to a profit. I've noticed a lot of these companies, some of these penny stocks who continue to do it. I've seen some of them explode. A big name that I just talked about was APPS. That was literally at $2 just over a year and a half, 2.5 years ago. And now it's at 100. I know there's not other names that I'm trying to think of. I know TNDM, which is like a diabetes company. That used to be, actually, to be honest, that used to be a shitty penny stock. I mean, they reverse split maybe 10 to 15 times. I may be going a little too generous there, but it might have been maybe 5 to 6. But they split a lot of times, reverse stock split, and but truly their product works. Apparently, as you can see, their revenues and earnings per share has grown, and that was a company that I was watching from $5 to $6, and now that's $150 in just over 2 to 3 years as well. So there's so many names out there, and I'm only naming two. I've seen so many names out there that have fully grown, and the biggest thing that I've seen is literally these companies that go from negative to positive earnings per share. So yeah, I'm going to go into this a little bit, just probably a minute or two. Don't want to, take up too much time. I know we got a lot more speakers and a lot more to talk about. But yeah, companies that go from negative EPS to positive EPS is definitely one thing to focus on. And there's so many free tools you could use to kind of look this up. For example, FinViz, uh, finviz.com, and you could literally put up parameters, earnings per share growth quarter over quarter. You could put positive sales growth quarter over quarter. You could put positive. You could look at current ratios and stuff like that, gross margins, like we've all talked about in this chat. I've heard a lot of people talk about that, and those are things you could focus on. And what I kind of did before was focus on names that were actually rising. They were in Their charts were rising while before earnings were coming, and they're in an upward channel, upward movement. And I would look at their past 1 to 2 earnings reports, see what worked, see what didn't, and kind of see how they guided over the next few quarters, see how they were growing from year over year and quarter over quarter. And if I saw 2 to 3 quarters of growth, quarter over quarter, and of course year over year, I would look into it a little more, and I would buy that stock and basically hold it into the next earnings. So I would look into the earnings call, I'd look at the guidance, I look at the earnings per share, I look at the revenue, see all this growth, and I kind of go through that. I used to trade a couple of these names, and next morning, I think I had around. At one time I was honestly writing it down. I think I had like a 92% success rate doing this on about 40 to 45 plays. So that, I mean, that's a pretty decent number just looking at past earnings. And yes, technicals means a lot. Stock Talk was just talking about that. I mean, I'm 99.9% a technical trader. The only time we really use fundamentals is for long-term plays. And that's basically for things in my IRA right now. I'm not really trying to grow a full fundamental portfolio right now, as I personally think the market is going to start to cool down just a little bit over the next 2 years, where I really want to start throwing in my money. And if I'm wrong, it is what it is. But kind of just want to wait for it a little bit from where I'm at right now, as I'm currently buying real estate, which we talked about in another uh, Twitter space here. But yeah, I mean, there's another thing that I know a couple of people were talking about in this space as well, is looking at these specific sectors. And for example, a recent earnings was KLAC and Qualcomm, QCOM. They're both in the semiconductor or chip sector, and they both beat earnings. They both gapped up on earnings. They both, guided up. And you kind of want to look at the rest of the sector now. So there's so many different names in the sector. I mean, you have some of the larger names, at least, is ASML, LRCX. You got AVGO, which is Broadcom. You can even go, NVIDIA, AMD, stuff like that. And you kind of look at how their earnings are going to be. So I think we have, who do we have this week? I don't know if we have any of those this week, but those are ones to definitely look at. As you see, these have beat earnings. We've had a chip problem over the past year. We've seen cars have gone up in value. Personally, my personal car, before all this, craziness was happening, I think it was around $15,000. I could probably sell it now for like $25,000 to $30,000. So basically double the value. I know a friend who actually recently bought a car for $20,000 and sold it for $35,000. So it's literally just insane in just a couple of months on how crazy, this chip shortages and everything. And as we've seen, Apple has talked about this, and not just Apple. There's so many companies talking about this, and it's causing an effect on their business. So there's and that's just another thing right there. There's so many factors on how one sector can cause an effect on other sectors and other stocks. So everything is all tied in. It's just kind of how you see the reactions to it, and how it all plays out, how they expect to overcome this problem or overcome this situation. And that's just another way. I know it's not, I guess, fundamental, but it's more so how it plays into the fundamentals in the future as well. And I kind of I know I went over the time limit a little bit, so I'll let someone else go in. But just to end it, yeah, you definitely want to look for year-over-year improvement and quarter-over-quarter improvement in the fundamentals. That's one of my biggest keys that I traded on and that I still trade on if I do play earnings plays. And like I said, if they're becoming profitable from a loss, are they going to continue this profitability? Uh, you know, why are they basically look into it a little deeper? Why are they growing? It's not what I wanted to say. Uh, hmm. Is there a reason for the growth, and how it will be continued going forward? So I'm going to pass it on to someone else, and we'll go from there.
Appreciate you, Nick. Okay. So I'm going to hit. I actually think that we've been running for about an hour and a half. So I'm going to go towards my speakers and just give them an opportunity. If there's anything else that they felt was not covered, if there's anything else that they want to share, plus any closing remarks, they can kind of just wrap that all up together. That way we have some time to disperse that out. So Luke, I'd love to go to you if there's anything else that you wanted to share. Any closing remarks?
Yeah, to keep it short and sweet, just if you're looking for, say, a longer term name, one of those things I really like to do, as I mentioned, is simply look at the trends within the fundamentals. And if a lot of those trends are positive, and if your criteria that you set after doing research and figuring out your system, um, if those boxes are checked, then, really determine how you want to enter. And I use technicals to enter a name. So I would definitely echo a lot of the other speakers here and say combine both fundamental analysis and technical analysis. And, a combination between those two is awesome. And I can speak firsthand that, I taught myself both over the course of 5-6 years, and the returns over those years have been excellent. So definitely a combination of fundamental and technical analysis will take you a very long ways. And yeah, everyone, go check out the Wolf app if you haven't already. The Wolf app is awesome. Our host here has an awesome app, and you got to go check it out. All the analysis and all the research you need is built within the app. There's a lot of big things coming up also, so go check that out. And then I typically release an article or two each week. They're very short and sweet. They go through the fundamentals quite simply, and they give you a great foundation to start your research. And you can find that on my Twitter page or at runningwiththemoney.com. So yeah, thanks for having me. I look forward to the next spaces. A bunch of great speakers up here. Phenomenal speakers, actually, a great panel. So give everyone a follow here as well.
100%. And thank you, Luke, for coming on. And since you mentioned it, say if everybody is interested, the Wolf app is a great place to do fundamental analysis. You can chat with people and do research. What we've done is we've attempted to take all the data from things like the balance sheet, the ratios, key statements in different areas, and we've turned it all into graphs ready for you. And we try to really simplify what it looks like. And yes, there's a lot coming into the app. So again, that is inside the link in my bio. If you did want to click into that, we have thousands and thousands of people that are using the app, and I highly recommend it. And then again, definitely make sure that you're following these speakers. And with Wolf, since you just mentioned it, like I said in the beginning of this, my name is Gav Blacksburg. You can see my account up here co-hosting. The Wolf app makes it possible for me to do all these Twitter spaces. They take care of my bills and all those nice things so that I can sit on Twitter for 10 hours a day, host spaces, provide free education as we build up the app and get more people onto it and everything that's going on there. So if you're enjoying that, definitely throw this Wolf account a follow. We'd love to continue build to get it ready over 30,000 and just getting started. Okay, Nick, did you want to go next?
Yeah, I just wanted to quickly go over some, just add in a couple notes. I actually just posted on your recent post the earnings reports for this week, or just the big few names. And like I was just talking about, Nvidia does report this week. AMAT reports this week. Those are some chip names to look at that are at least in the sector. So keep everything on watch. Tomorrow we got names like Walmart, Home Depot, C, JMIA, and we got a good list this week as well. Wednesday we got Target. So there's a couple of names this week. Other than that, posted that up for everyone, and I'm gonna be hosting a 50% off discount for Black Friday coming up. So if you guys wanted to join my site, you can at www.bulltradefinder.net, and the code is capital B, capital F50, and I'll post that in there too.
Awesome. Thank you, Nick, for hopping on. Okay, Brad?
Sure. I'll leave people maybe with one idea. So when we're maybe looking at new IPOs, which is where I spend almost all of my time exploring new ideas. So I think it's important to talk about the first maybe 25 S1s, which is that's the lingo for public prospectus. The first 25 I read maybe all sounded amazing to me, and now I read 25, and I think one sounds sort of compelling. So I think just the idea of doing this reading and putting in some of the work and trying to start seeing patterns in how these in these S1s kind of puff and or not puff, but how they highlight their business, because we have to remember every single CEO and CFO is incentivized to say they're the most amazing company in the entire world and they do everything better than their competition. So maybe how to separate what's real and what's not real. The thing that I'm really looking at or really looking for most in these S1s or F1s if it's international is third party data to kind of support the claims that they're making. And I talk about this a lot. So 80% list price discounts for GoodRx, 17% APR reduction for Upstart, 27% higher birth rate for Progeny. I mean, I'm not great at evaluating one fertility benefit solution versus another. I'm not a fertility benefits expert, to surprise everybody in the panel. I'm not. I can't just read. I can't look at an algorithm, an AI algorithm, and say that one's better than the other one. But what I can do is I can observe these outcomes from third parties who have no incentive to say that this is better than the other one, and take that outcome as evidence that it truly is better, and they're not just talking up their own ASS or I think I can swear in this space is that they're not just talking up their own ass. So not taking everything that management says with a grain of salt and looking to verify that and vet that through other sources, other data sources that aren't the actual company. I think is one of the key ways that I build conviction and key ways that I build confidence in a position. And I think that's extremely valuable. So wanted to put that idea out there. Thanks for having me as always, Wolf. Always fun, great speakers. And I'll talk to you again on Wednesday.
100%. We will be doing an earnings space on Wednesday. We're going to talk more Butterfly. We're going to talk SE. We're going to talk NVIDIA. Those will all be at Wednesday at 5 p.m. EST. So good stuff there. Okay, Stock Talk Weekly. Would love to hear any other thoughts you have to share.
Yeah, man. As usual, thanks for thanks for having, thanks for following me. Thanks for having me.
You're welcome.
Yeah. You guys should definitely follow, Wolf Financial, Gav. You follow his personal account as well. He's a great guy, really great host, really patient with me, going on my monologues all the time. So I appreciate that. Follow the co-host, Evan, as well, Stock Market News. Another great guy, puts out news before Bloomberg gets it. So good place to react to that. And follow the other speakers as well. Brad, he's a handle as Stock Market Nerd. He is just that. He's very good at the fundamental analysis and gives very long theses on his stocks as well. So check him out. Check out the Bullish Rippers page, which I know they sponsor Stock Market News and Wolf Financial as well. Luke, I liked what I heard from him as well, so give him a follow also. But just coming from me to close, I think some of the bigger themes here really were no one looks at everything fundamentally or technically. The key is to become educated in how to do fundamental analysis, how to read a balance sheet, how to read an earnings report, how to read an SEC filing, all of them, all of the important ones at least, and knowing how to scan all of those documents for key information. But it also comes from deep diving the sector and what numbers are more important compared to peers in which sectors, because in certain sectors margins matter more than they do in other sectors. In certain sectors, capex and how much you're spending on R&D and all of these things can matter more from sector to sector. So it's a case by case basis, but learn how to fundamentally analyze companies and learn how to technically analyze charts and decide which of those indicators or aspects are useful to you or that you find to be actionable to you. You're going to find some data that's not actionable, and if you're a trader, that's not a good thing. You don't want non-actionable data if you're a trader. If you're an investor, there is some non-actionable data or non-immediately actionable data that you can digest and keep in your memory bank for a reason why you like the stock. But either way you do it, make sure you know a little bit of both. Don't be somebody that's married to a school of thought and you just ignore the VWAP and the RSI and the MACD and the moving averages and the supply and demand zones. Like if you're a fundamental investor who just ignores all of that, you're going to have really bad cost averages and you're going to have really volatile months where your position is swinging from red to green because you don't know what a good entry is. And if you're purely a technical trader and you think, oh, the stock has room to 30 and you watch it run to 20 and you're not paying attention to the market cap and realizing that it's becoming massively overvalued, you might be holding and hoping for that 30 forever. So learn to integrate the two to whatever degree seems fit to you. More short-term traders technically want to be more tend to be want to be more technically focused, and more long-term traders tend to want to be more fundamentally focused. But there's a healthy mix of both that will give you better entries, larger ability to compound profits, and on top of that, on the fundamental side, it'll make you more aware of what you're holding, and it'll help you better identify value. The only way to find a trade is not one or the other. If you leverage both fundamental and technical analysis, you'll find the best trades, the trades that have room to run on the fundamental side and have room to run on the technical side. Those are the bangers.
Those definitely are, and I see you've been posting about a few of them throughout. Make sure you're checking Stock Talk Weekly's timeline. Always just putting out really good ideas, food for thought, response to comments, a lot of really good stuff there. Brad?
Yeah, just wanted to say we've talked, we've thrown out a lot of lingo that might not be 100% people comfortable with, I guess, but there are amazing resources online. You know all of them, YouTube and Wolf Financial for the plug, but there are awesome universities like MIT and University of Michigan, Go Blue, that have these that have world renowned professors that are literally sitting and teaching us the basics of accounting and teaching us the basics of finance absolutely for free. So I'll leave us with that education and that introduction is immensely valuable from an understanding point of view and from a time saving point of view. And the resources are there right now and they're so accessible. So I just encourage people, maybe if you're bored on a Saturday, enroll in one of these classes for free and start learning. Not to sound like a nerd, but I guess I'm a nerd. So yeah, that's what I wanted to say.
Awesome. Thanks, Brad. All right, Evan, my wonderful co-host, and also Evan runs the Bullish Rippers account, which you can see up here. Bullish Rippers does sponsor a number of our spaces and puts out some amazing content. So make sure you're following both Bullish Rippers and Stock Market News. Evan, any final thoughts?
Yeah, quickly before I get to that, I was on an earlier Spaces of yours, and I heard quickly you talking about some calendar or Google Calendar or whatever you had. I was wondering if you could explain a little bit more about that first.
Yeah, definitely. I'm happy to mention the calendar at any time now that we have over 800 people signed up for it. So if you're not already on the calendar, myself and Stock Market News run this, and it's probably the best product that we've run. Literally, someone at Twitter today DM'd me their email and asked to be put on this calendar. So that someone who works at Twitter Spaces. So essentially, we're running about 10 to 15 spaces a week. It's really hard for people to know when all these spaces are happening unless you're constantly checking Twitter, you throw in notifications, all this different stuff. So we made it really easy. We created a Google Calendar that you can essentially just DM one of us. If you want to shoot over to me, just DM me your email and we will add you right onto the calendar. Easy peasy lemon squeezy. It is free. There is no, charging time. You can unsubscribe if you would like. But what it does is it puts all of the spaces onto your calendar. You can see who's going to be speaking. You can see the topic. Everything will be smooth. So that is the Google Calendar that we have. Again, just feel free to DM me your email and I will add you to it tonight. I see DMs coming in now. Love it. Like I said, over 800 people are using this. People at Twitter use this, so you should probably be using it. If you're not already on, just go ahead and DM me right now. I will literally add you to it tonight. Even if I have to stay up into the wee hours in the morning, I will make sure that you get on this. Perfect. The DMs just doubled. Love to see it. Okay. With that being said, I'll throw it back to you, Evan, if there's anything else you wanted to talk about.
Yeah, no, thank you for explaining that. Honestly, that's one of the best things, most powerful things we've created. So I highly recommend you guys send them a DM. Just when you do it, you can send it to me or him. Just make sure you include your email as well to expedite the process as much as possible. But other thing I wanted to add on the topic was, no stock trades in a vacuum. Everything is based on every stock will move based on other factors in the sector. So you can't just, when you're looking at Tesla, you can't just look at Tesla. You have to look at the entire EV market as a whole and all the EV stocks. You have to compare it to the competitors to make decisions. And there was kind of a couple talks and like trying to get together overarching rules like this PE or this gross margin you're looking for. And the problem is you can't really do that because it's industry specific, it's stock specific, it's sector specific. So a great way to get that information a lot of time is to look at the peers of the company, look at its competitors and see what they're trading at, and then kind of compare it to your company. So your analysis is never complete if you haven't looked into the competitors yet. With that, I think that's good with this. I would love to get one of these spaces going again. I really think fundamental analysis is something super important. All the people we have up here right now are really great and really experts at this. So make sure you're following all of them. And I'll throw it back to you, Gav.
Yo, guys,
Yeah,
just
100.
real quick, one thing I wanted to say on Evan's point was, I think if we're gonna do these going forward, and I would love to do them with Brad, especially because I know Brad knows his stuff fundamentally. But, you know, if we're gonna do these going forward, I think we should specify them on different aspects of fundamental analysis. To keep them focused. So, we can do one on peer analysis, which I would love to speak on because that's really my bread and butter. We can do some on intrinsic balance sheet analysis, which I know Brad is very apt with. And we could do different sectors like that and break it down. I think that'd be more helpful to the listeners. I don't know what you guys think about that.
Yeah, I definitely agree. So we did one of these beforehand, and it was just like very broad, and it was more like, oh, looking into the people that run the company, and looking into do you use the company everyday life and stuff like that, which is a little bit maybe not technically fundamental, but kind of. And then for this one, I really wanted to focus more on like the earnings, which I think we really hit on, talking about earnings and going through them, and then we kind of varied out. But I completely agree with you. I think, the audience would love to have more specifics. It just continues to keep the conversation controlled. So yeah, we'll definitely do that. I'm thinking about spacing these about 2 weeks apart. I have like a series of spaces that I'll do. Like I have a market psychology space that you'll be on with me. I think you're co-hosting. Like that's I do every 2 weeks, so stuff like that, and just continuing to hone in on topics. A really good idea there, Stocks Weekly. Okay. With that being said, thank you to everyone that has already DM'd me your emails. I'm excited to add you onto our calendar. I think the calendar is going to have 1,000 people on it this week. That's amazing. It's how we get so many people coming onto these spaces every single day. Tomorrow, I'm going to be doing 3 spaces. 3, 2, 3? I think 3. I'm not 100% sure. I probably have to check my own. I get a little bit lost in the sauce with how many spaces there are nowadays. But I know that there is going to be a 2 p.m. EST one. And the 2 p.m. EST one, okay, perfect, there's 3, is going to be on technical analysis and charting. That's going to be a very elite panel, I will call them, of TrendSpider Jay, so Jake from TrendSpider, Ben from Pattern Profits, and Richard Moglin. So there's just those 3. We're going to take a ton of tickers from the audience because it's a small panel. At 5 p.m. EST, I will be co-hosting with Stock Talk Weekly. We're going to do opportunities in crypto. We're going to have a few really good names in there. And then at 8 p.m. EST, every Tuesday, I host a market sentiment and technical analysis space with Evan will be hosting that, and then just a swarm of amazing speakers: Danny Oscar, Gavin, Mel Stone, Stock Talk Weekly, Juicy, Vegas, a whole bunch of people will be on that. So make sure that you're following my speakers. Make sure you're following the Wolf account so that you can be seeing all these spaces at the top of your timeline. With that being said, wishing everybody health, wealth, success in all you're doing. If you're going to watch Monday Night Football, please root against Darrell Henderson because I'm playing him in fantasy. And I hope everybody takes care. See you all tomorrow.